If you are self-employed, you earn income from a business that you operate. Being self-employed means that you set your own hours of work, you charge for your products or services, and you pay your own taxes. The self-employed can also be independent contractors. That means that they enter into agreements or contracts with businesses or individuals for specific tasks or functions. The advantages of self-employment are that small business owners have the freedom to set their own work hours. They tend to do well financially, and it has some tax advantages, such as the ability to deduct a variety of expenses from annual taxes, and they often have the option to later sell their businesses for a sizable profit. However, there are risks to self-employment. The Small Business Administration says that only about 50% of small business startups last 5 years, and only 33% or one-third are still around after 10 years. The default legal structure of a self-employed individual is a sole proprietorship. So the advantages of that structure are that it's easy to start up and requires no legal registration or paperwork. You are the owner and you are in charge of the decisions. And losses from your business can lower your tax liability. On the downside, you have unlimited liability. That is, you are totally responsible for paying any business debt and expenses. All income and expenses from the business activity flow through to your personal tax return, including paying for income tax and self-employment tax on the earnings. That unlimited liability means that you are totally responsible for paying any business debt and expenses, and all of the liabilities that the business incurs, like debts, lawsuits, and taxes, are yours. These liability amounts are not limited to the amount you invested in the company. This means that if your small business runs into financial difficulties and you are unable to pay your obligations, your personal assets can be seized by creditors to pay the debts and obligations of the business. If the latter occurs, many small business owners file for bankruptcy to protect their remaining personal assets. Bankruptcy is a legal process through which an individual's assets or income are divided among their creditors and any remaining unpaid debts are forgiven. Now, a partnership is another legal structure. In general partnerships, decision-making is typically by majority. Capital, which is the money used to start or expand the business, can be raised through the collective assets of the general partners. Taxes are calculated on each partner's share of income, and each partner has unlimited liability for the entire partnership. With a limited partnership, a general partner manages the business and one or more limited partners invest money into the partnership. With a limited liability partnership, partners are not liable for the negligent actions of other partners, but they are liable for the general obligations of the business. A major drawback of that general partnership, remember, is that each partner has that unlimited liability for the entire partnership. That means that each partner is totally responsible for the mistakes of the other partners. As a result, other partnership structures have been developed, like the limited partnership and the limited liability partnership. So with a limited liability partnership, a limited partner's liability is capped at his or her investment in the partnership. Limited liability partnerships are designed for professionals working in a partnership. Partners will not be held liable for the negligent actions and resulting liabilities of other partners, but they will still be liable for the general obligations of the business. So many doctors, attorneys, and accountants use this type of partnership. A limited liability company shields the personal assets of the owners from the liabilities of the business. This is one of the most popular business structures. If the business cannot pay its debts, Creditors can claim the assets of the business, but they cannot claim the non-business assets of the owner. A limited liability company, or an LLC, is similar to partnerships in structure, but limit liability much better. There are higher legal costs, but the added liability protection generally outweighs those additional costs. Another way to avoid being personally responsible for the liabilities of your business is to form a corporation. A corporation is a legal structure that is separate from the owners of the business. It's very effective at limiting liability, but it's also expensive to form and maintain.